WPP's 25% rebound after its half-year results changes the obvious reading of the stock. The immediate explanation is not a return to strong growth, but an easing decline combined with tighter costs and a modest margin improvement. Revenue less pass-through costs still fell 4.7% like-for-like in the first half, while the second quarter decline moderated to 2.8% from 6.7% in the first. That explains the relief, but not yet a durable turnaround. Legacy client losses remain, and WPP still expects revenue less pass-through costs to fall by a low to mid-single-digit percentage in the second half. Before this event, recent coverage had framed WPP as a damaged incumbent caught between lost clients, duplicated structures, and the race to build credible artificial intelligence capabilities. The company's market value had fallen sharply from its earlier peak, while the loss of Mars's global account and a profit warning intensified fears that WPP was on the wrong side of a structural change in advertising. Analysts and industry sources also questioned whether the group might eventually be broken up. The current results show why that interpretation has become less complete. WPP is moving from a complex holding company structure towards 4 integrated units: WPP Media, WPP Creative, WPP Production, and WPP Enterprise Solutions. The direct mechanism is visible in its cost base. Headcount fell 6.4% year-on-year to 97,388. Staff costs fell 5.9%, and management is targeting £100 million of savings this year, rising to £500 million of annualized savings by 2028. That can protect margins even while clients spend less. Yet, the numbers need careful handling. Headline operating profit actually fell 3.4% to £398 million in the first half, while the operating margin improved to 8.4% from 8.2%. Reported operating profit rose 18.1% to £261 million, helped by lower impairment charges. The share price move therefore reflects a mixture of better operating trends, cost control, and easier comparisons, rather than broad-based earnings growth. There is a more constructive reading. WPP says the second quarter improvement was helped by better performance at WPP Media, new business wins including Estée Lauder, Wendy's, Skechers, Tesco, Huawei, and Uber, and improved client retention. Net debt also fell 10% to £2.94 billion. The dividend was maintained, and the company retained its full-year margin forecast of 12% to 13%.
But that evidence is still conditional. The bodies do not quantify how much those new wins replace the lost legacy accounts, nor do they show that client retention has translated into sustained organic growth. The second quarter improvement was also helped by easier comparisons. A smaller decline is meaningful, but it is not the same thing as a return to expansion. The longer-term question is whether WPP is becoming a more efficient advertising company or a genuinely stronger technology-enabled marketing partner. WPP is investing roughly £300 million a year in artificial intelligence tools, while its open platform is being used by tens of thousands of employees. Its 5-year partnership with Google is intended to embed products such as Gemini and Veo into the group's services. That may eventually reduce production costs and improve the offer to clients, but it does not yet prove that WPP can charge more for the work it produces. This is where the second reading matters. The company may be stabilizing because it is cutting its way to better margins, while the underlying industry is still becoming more competitive and more commoditized. WPP's chief executive has acknowledged that outcome-based payment models are still years away. Until then, the group must demonstrate that artificial intelligence creates pricing power or stronger client retention, rather than simply allowing clients to demand more work for less money.
For a holder, the useful reconsideration is what the rally is actually rewarding: early evidence of stabilization, lower costs, reduced debt, and preserved dividends, rather than proven revenue growth. For a watcher, the risk is reading a 25% relief rally as confirmation that the old business model has been repaired. The next observable checkpoint is WPP's second half performance. Revenue less pass-through costs must remain within the guided low to mid-single-digit decline, while the company works towards its 12% to 13% headline margin and this year's £100 million savings target. Those results will show whether cost control is buying time or creating a foundation for renewed organic growth.
The strongest current judgment is that WPP has moved from deterioration towards stabilization, but the evidence does not yet establish a structural recovery. The unresolved issue is whether new businesses can replace lost revenue before the benefits of restructuring and easier comparisons run out.